So welcome back. This is module 7.2, and here we're going to be focusing on the type of capital that's aligned with your mission and make sure that the expectations you're setting with your investors are correct. And then the investor return. And what we'd like you to do is sort of think like an investor, if you will. Walk in their shoes. Try to understand how they analyze things. That'll help you communicate more effectively with them. So the first thing is a scenario that we picked off of the Tonic report that came out. And the information here is not overly important, except to note that there were 500 applications, 85 different interviews, and only 15 were actually funded. This is not an unusual relationship. That's 3% of the people who applied for funding actually got funding. This funnel activity is very typical. So what we'd like you to do, and with your mentors, is to consider making sure that there is a high degree of alignment with the impact investors that you engage with, so that 3% number could go up significantly. Now, there is a range of social impact investors and definitions, so be careful. Some just care that you're not there, that the organizations are socially responsible, but they're really economically oriented. They want to make sure that you're not polluting or selling cigarettes or things like that. Our people are all in the other part of the slide here, which are talking about impact for the people at the bottom of the pyramid. And there is a range within this group which we'll talk about, but make sure that impact is critical to your impact investor first and foremost. Now we're going to run through something here that's conceptual. Don't read too much into this because it's only a graphical representation. But think about a vector that talks about the social impact of your business and the investor return. Now, in many cases, there are different types of impact. There can be breadth of impact, meaning you're touching tens of thousands, hundreds of thousands, maybe even millions of people with your solution. But in some cases, there's the depth of impact. Well, that may mean that you're only doing hundreds or maybe thousands of people, but you're saving lives or you're transforming lives in a very meaningful way. So consider where you fall in that spectrum, both in terms of either the breadth of the impact or the depth of the impact. Now, from the investor's point of view, there's also a range of outcomes. There's the returns which are market returns, meaning they're not only getting their money back, but they're getting an internal rate of return at some point between 5 and 20%. And those are economically oriented impact investors. At the end of this spectrum, where people only care about the social return, they're not expecting their money back, but they'd like to be sure that the investment they make is providing great value to the beneficiaries. So if it's a social return, that is the one on the bottom left, that you need to be able to calculate a number that's easy to understand. So one way to think about it is the cost per outcome times the number of beneficiaries. This is efficiency measure. This basically says that I'm going to take the impact investor's money and I'm going to turn it into benefits at a very high rate. On the other end of the spectrum, if I'm an economic investor, my return is the margin per outcome times the beneficiaries. And this is really a log scale, meaning it's not just a few thousands, it's really hundreds of thousands, millions, or even tens of millions to be able to get the type of financial return that they're looking for. Again, margin per outcome times the number of beneficiaries. Now, if you looked at this and you said, okay, there's a line that goes through this graph here, which is the risk-adjusted return. This is the way the impact investor is going to look at your organization. And admittedly, this is oversimplified, but consider where you fall on this line. So you may fall above the line or below the line or somewhere along the spectrum. But it's incredibly important for you to be able to understand what the expectations are that you can set with the impact investor, which directly relates to your credibility and allows you to be able to communicate with those types of impact investors who are looking for the types of returns and social impact that you're able to provide. So in large measure, there's 3 different types of capital here and matching the investor's expectation. There's impact only, grants, gifts, those kinds of things. There's impact first, which is a bit of a blended return. Remember we talked about this with carbon roots. That is, there's social return for sure, but then there's also some kind of economic return that comes with it as well. And then there's the people who are more economically oriented, getting a financial first return. So this is a simple table for the types of capital. I'll leave it to you to read it, but think about impact only, impact first, and financial first, and what the expected returns are. So for impact only, it's just that the capital is not returned at all, but they're very focused on the metrics that they're provided. The impact first is they'd like to recycle their capital. They want some of it back in some form, or maybe all of it back, and they'd like to recycle it. And they're focused on both a combination of sustainability of your organization, both in terms of the impact, but also that you get to a point where there is no need for continued investment. And then finally, the financial first investors who are looking for an internal rate of return on their capital, and are going to be focused on that cumulative net cash flow number we spoke about earlier. Now, these are the preference for impact investors that are either in the impact first or the financial first. So most of them are looking for market returns. And again, setting your expectations, if your organization is not going to produce market returns, it narrows your focus a little bit, and you may want to move to people who are more impact oriented or impact only. Now here's a laundry list of investor terms, some of which you may be familiar with, some of which you may not be familiar with. But you should know these things, in particular when you're communicating with investors of a certain type. The difference between a term sheet, which is an outline of the terms and conditions of the funding, and the definitive agreement. So a term sheet is how it's negotiated. The definitive agreement is actually the legal document that's there. In equity, the stockholders are likely to be looking for some sort of preferred stock, or some preferences, rights and preferences that could include participation on a liquidation event, rights of first refusal, anti-dilution criteria, board seats, voting rights, etc. Talk to your mentors about this and see if there isn't a way to get a deeper understanding. Now in the debts, and on debt, you also have the sort of convertible debt, which is kind of a quasi-equity. That means it starts out as a loan, but it has the right to convert to equity at some point in time. Typically at a discount of what the new investors would pay, but there may be also a cap on how much they're willing to have there. And there's a lot of things that the banks and other sorts of debt investors will ask for, including information rights, rights of approval, and those kinds of things. So be careful about the constraints that they put on you. There's also variable payment obligations that could be based upon royalty of your revenue or your margins, and there's the demand dividend. Again, your mentors should know a little bit about this, and if they don't have the information, we've got impact capital people here who can help you. Other terminology for financial returns are return on investment or return on equity, internal rates of return, or cumulative net cash flow. And there's a nice resource called Investopedia, so you can go to there and actually get definitions. So when we talk about metrics, we certainly talk about business metric. How many widgets did you sell? How many people did you educate? How many healthcare outcomes did you have? Then there's the impact metric, which is the quantification of what the impact is actually on the human beings themselves. We often point to IRIS metrics there. But I'd like you to think about financial metrics as well, because that's how your impact investor will think. Return on investment, internal rates of returns, and cumulative net cash flow. Now last but not least, and probably the most painful, is the diligence folder. So before any investment, independent of whether it's debt or equity, they're going to want to know what your organization has, both in terms of assets, obligations, agreements, and other things. So you'll be asked to share these documents with investors, and if you do the work now in preparing, it'll save you time later. There's an easy way of doing this. either create a box or Dropbox folder or some other thing that the mentors also have access for. Populate it according to the GSBI prioritized checklist, which is in the resource library at group site. And then when you're at a point, you can share it selectively with investors. Last but not least, 7.2 deliverables. So update your business plan, update your impact metrics, make sure you can add financial metrics if at all possible, and start populating your diligence folder. Thanks for listening. I'll see you in August.